Saturday morning, new month, almost here. In fact, for the stock market, we did close for the month yesterday. So we do have the monthly close along with the weekly closing, and that gives us some new things to look at and talk about. In fact, one of the talking points has been the overbought conditions on a monthly level where the RSI is high. It's at around 81, 82. So I cannot say it's super high. Of course, 85 is the highest reading we've seen in the recent past where markets have peaked, and on the quarterly level, it has gone all the way up to even a 90, 91, all the way back in 2008. We are not there yet, but in the 80s, we are at levels where you can argue both ways. But what can keep it up here? Can you develop negative divergences? Those are also things to consider. So this is me, Rohit Srivastav. For those of you who don't know, I'm the founder of IndiaCharts and Strike. Strike is our data analytics platform, which if you have not tried, you should, with a 7-day trial, because according to me, it's the best analytics stock market platform that you're going to need. Once you're on it, you're hooked, and then you'll not need any other platform for doing your market analysis, fundamental, technical, or whatever you do. Everything is in one place, all information and all data. So that's what we have done, and there's a lot of innovation coming up, which I can't completely disclose, and you are going to love it when it does show up. So we leave it at that. And IndiaCharts, of course, is the app. IndiaCharts app is where I write my daily content, and you can actually read about my views with charts apart from this rant, which sort of gives you an overview of the many things that I look at and think about. A few people look across the board. They're pure technicians, they're pure fundamentalists. I consider myself a market analyst because my approach to the markets ever from the beginning when I came to the market was to make money, right? That's why we all come to the market. So I did not come here for a career, though that is an outcome of wanting to be a part of the market and to make money here. And therefore, when your approach is making money, you do what anybody who wants to make money does, which is study everything and anything there is about the market, which means you want to know the fundamentals, you want to know the technicals, you want to know the economic and macro aspects, and you want to listen to everybody in case you just missed out on some of the finer details. So that is sort of how I recommend everybody approaches the market as well. Study yourself, do your own research, don't depend on others. You may listen to smarter people. That's part of what we call as confirmation bias, right? Which is part of the biases which are in behavioral finance. But confirmation bias can be good, bad, and ugly. We should do our own work is how it should work, because then your confirmation bias is essentially checking on what work you have done versus what somebody else is saying. Like I said, you do listen to smart people. I listen to a lot of them. I listen to a lot of YouTube videos, both Indian and a lot of more global and macro, so that we get a fair understanding of what is happening. So that's also part of our learning curve, because if we are not continuously learning, we're not improving and getting better than the crowd, and the crowd is going to compete with you, right, to make the most out of the market. So you could better be getting better. So this is my approach. I look at everything. I'm able to connect the dots thanks to Elliott wave analysis, which is the groundbreaking work of R.N. Elliott, which is a behavioral study of markets. It's a behavioral pattern. For those who don't understand it or think it's like watching the stars, it's not. It's far beyond that. It's like watching the crowd. So you're actually seeing crowd behavior in a pattern on a map, which is where you can actually study it, where it is repetitive in behavior, because people as a crowd tend to have the same kind of reaction to the same events over and over again. And that is why you see a particular pattern. And once you know that, you're studying the crowd, you're doing crowd psychology, you can use things like sentiment indicators, which are part of the Strike platform, and determine when the crowd is getting excessively bullish or bearish. So that's where the connecting dot starts to happen, and we can actually do wave analysis of everything from bond markets, currency markets, equity, and that is where macro analysis starts fitting with equity analysis, right? You're able to then draw the lines from, okay, what's happening here, what's happening here, what's happening here, does it all match up? Are the narratives that are being sold to you really true? Do they show up in the charts? Are interest rates really going up? Are they really going down? Are they going to sustain? Can you be ahead of the market? Can you know rates are going to go down before Fed announces it? And the answer is, of course you can. Bond yields have been falling for the last several months now, and you could have been well ahead of this trade, and we've been talking about it. So that is sort of how you approach the market. When you start thinking of behavioral analysis, you start compounding it across asset classes, and then you can connect the dots. So that is my approach. That's what I write about with charts on the IndiaCharts app, and allow you to do your own analysis of all these items In fact, we will include economic and macro data points also on strike at some point of time. So we started with equities and NSE. We'll move on to commodities, currencies, and then the rest of the market. So where is India in all of this? Like I said, we have overbought readings, but we are still stretching. So you can't really call it a top till it has completed a particular cycle, a complete wave structure. And so at each point of time, we are trying to judge that. We've gone a slightly back and forth on sentiment because sentiment was excessively bullish in Jan, Feb, March. Then it cooled off, got excessively bearish before the election results. And now we are back at new highs, and we are seeing this back and forth in sentiment. Now, when we put that along with the wave structure, it shows that something is not complete on the upside. So we continue to be bullish. But as we enter September, we are out of the seasonally bullish period, right? So this June, July basically is the high seasonal peak period. We do have seasonal data also on strike. So the seasonal data shows June, July is the best months of the year. August flat and then down into the depths of September where it gets negative and then starts to improve, between October and January again. So these cycles are sort of help you navigate. It may not exactly be like this, but it sort of tells you that if, this is the chart pattern I'm really looking at, this is the wave structure I'm looking at, how can it play out given the seasonality? And in that sense, right now, I expect some upside into mid or late September, and then there could be a correction because this time around, you also have the US election season. The US election season also has a pattern. At least the last two elections I watched, both of them saw corrective phases during the September-October period till the election results really came out. So there's this one and a half month period where US markets go either completely dead or they zigzag both ways up and down. They swing till the results are really out. So they don't make new highs after a point of time. We are still seeing higher highs right now. But at some point of time, you'll see the US market just go dull, dead, or, doing absolutely nothing. Then we'll be purely studying the near-term momentum of our own market, trying to judge where it's headed. Now, in our own market, the good part is that while a lot of liquidity is flowing in, it is shifting sector to sector and stock to stock. So overbought readings in one particular area or even overvalued readings, when we look at valuation charts, can shift liquidity from one sector to the next. And therefore, that rotation doesn't allow the index to really come down that much. There was a very interesting data point which I was seeing in an interview in fact, a presentation that got onto YouTube by Prashant Jain in the morning. And what he was highlighting is that, we all talk about one side of the equation, that is demand, right, which is coming from liquidity. DIs are getting a lot of fund flows, SIP money in Indian market. So how will Indian market ever come down? And in fact, there was an argument earlier in the year that why doesn't the government actually, and this one was from Ramdev Agrawal, that why don't they really do PSU divestments, right? That would provide more supply to the market when there is so much liquidity and keep it from getting superbly overvalued. But partly that's the corrective function that an IPO market really does. It's a natural function that when there's a bull market, more IPOs start coming in, and as more IPOs are successful, even more IPOs start coming in, right? So when you have, it's not just the SME IPO market, but the other side, which is like the big bang IPOs of Zomato or now coming up Swiggy, which look at high valuations and they get listed at super high valuations. These are also big intakes of money. So on the one side, you have a lot of demand, a lot of money, liquidity coming in from domestic investors. On the other side, you have a lot of supply also, which does the balancing act. So that can partly explain why after 2 years of very good earnings growth last year, in fact, we had in the Nifty compared to the slight slowdown at the start of this year, the P ratio is stuck at 21, 22, 23. That means that the market has really not been running ahead of earnings growth at a Nifty level. There may be certain sectors, there may be certain segments, which broadly, I think now everybody knows, everybody said this in interviews, mid-cap, small-cap, and defense and railway stocks have gotten ahead of themselves. But if that is true, that leaves out a lot of the market, right? You had undervalued pharma stocks, like I mentioned in a tweet of mine on Twitter. I've written about banking, and that also everybody started to talk about, just like we were saying PSUs 3 years ago. The only difference is nobody agreed on PSU. Now, at least some people are agreeing on banking. There are still a lot of people who disagree. Pharma, I think, is pretty much become consensus bullish. And so you have this backdrop where money, like I said, shifting out of valued sectors, overvalued sectors, is moving into others. So liquidity rotates itself, which is why Nifty doesn't give us a big correction, even though individual stocks have fallen in between quite a bit. And therefore, it is becoming harder and harder to call a top end correction in the market at a Nifty level, though at some point of time, some structure will complete and we will get a cut deep enough to get this RSI come down from the monthly chart. Quarterly charts, it can stay elevated for even longer, during a bull run for several quarters. But at a monthly level, it would help to bring it back to a 70 reading and then again go back to an 80, 85 reading. So you do want that at some point of time. I don't know if when it's coming. I probably think Jan, Feb, again, the same annual seasonal cycles kick in for some correction. I don't think it will happen right now, right away. But there could be a dip somewhere in the later part of September is something I'll continue to watch out for. So this is the setup that I'm really looking at, which means even short term, we do have some negative divergences on our swing indicators that can give us a dip, but that usually lasts for a couple of days and then things start improving again. So it won't be something massive. It will be of interest to traders. It may not be of super interest to investors who will probably want to buy the dip again. So liquidity is there. There's also supply. Let's not forget that. And when liquidity and supply both, mismatch, that is when major market swings happen. Remember 2008, when the major market top occurred many months after the US. US peaked in October. India continued to go up till January when you had the Reliance Power IPO. And that finally called the top. So that is what supply is all about. Sometimes we don't see it that way. We see it as, the mark of the bubble was the Reliance Power issue. But essentially, that was also the mark of supply or oversupply on the other side. Demand was already there. And once you got a lot of supply in, that finally ended that particular move, which would have ended maybe on the housing bubble later on. But that sort of ends up becoming the peak where supply comes in. So right now, we are seeing a lot of demand. We are seeing a lot of supply. When will the two mismatch? When will one override the other? When will there be an oversupply problem? I don't know. Requires a lot of data crunching and data watching. But for the time being, we know there's a lot of flow. We also know that we are in an interest rate cycle that is going to head from higher rates to lower rates, something that the bond markets have been signaling for quite a while. The only one who's still not open about it is the RBI, right? The Reserve Bank of India. This despite that we are getting a lot of currency inflow from other means than FIIs, and therefore our currency reserves have been rising. But surprisingly, the USD INR is not reflecting it, right? The currency pair has been weaker than normal, partly to do with because other emerging markets also are showing the same trend, slightly weaker currencies against the dollar, even though the dollar is getting weaker against other advanced economies. So we have this divergence right now going on. I feel it is a late divergence. A late divergence is one where at the fag end of a dollar trend, when the dollar is already reversed to the downside, other currency pairs have not reversed. Now, this bigger lead lag was not there in the year 2000. So it was easier to call once, the DXY had reversed, even the rupee had reversed within months. And you got a trend reversal slowly but surely. But right now, the USD INR is still not giving a clear-cut sell signal on higher time frames. We are seeing some resistance, but I still see the potential for a 50 paisa, 30 paisa spike, last spike, maybe to 85, 20, 30, before it actually starts heading down. So leaving that open, unless it breaks down and we get a confirmation that, okay, now it's done, there's no more upside, that I will leave that last spike open for the USD INR. So that is where the currency market this time is not perfectly confirming, and that is why people can get confused, right? This part is still not adding up. The RBI is still not cutting rates. The Indian banking sector still has problems. There's a deposit problem, banks will shut down. No, they'll not shut down. They've already been through the worst on NPAs. Now, this is, this bad news actually supports negative sentiment. So I say negative sentiment is what? I say when valuations are low, they're because of some reason, right? It's a sentimental reason. You either think growth has come down, or if growth has not come down, you think there's something wrong with banking, that is why they're off. And so a lot of bad news starts getting supplied to the market, and that negative sentiment is why I look at valuation charts and say they're sentiment charts, because low valuations mean weak sentiment. And that's sort of reflected in the banking space where we say, oh, FIs have over ownership. FIs had over ownership even at the start of COVID. That was the reason they were underperforming on banking, but banking eventually picked up. Now, once again, banking is moving slowly, and we say the same thing. There's over ownership, and therefore they end up selling that. But the bank index did make a new high post the elections. So that's not the only reason. And then you have all this deposit and other reasons coming up. Credit deposit ratio has gone up. Yeah, it had gone up during the election season. It's come off a bit. And if the capex cycle does pick up and there's more credit, you do want more deposits. And will higher rates get you more deposits or lower rates get you deposits? And I've actually heard arguments both ways. Some people say, oh, well, deposits are a problem. You can't cut rates. And there's another argument that says, well, if rates get cut, there's more borrowing, and that results in a lot of cash generation that ends up getting deposited in banks and brings the credit deposit ratio down. The second argument does have its validity. After all money just flows in the system, right? If it goes out of one bank, it goes into another. So someone actually asked me this question that, yeah, if there's a credit deposit ratio, you're saying money is going to equities. Well, after you buy the equity, it's going to somebody else, into somebody's bank, right? So why doesn't it show up? So it's really not a problem of that. It's really a problem of how much credit you're creating, and is that going, is that creating more cash in the bank? So I think the rate cut argument can work in terms of bringing down the credit deposit ratio. We have seen the GDP print yesterday come in at 6.7% and slightly below the lowest for the year, and all that news is all over the papers. And that is the low point, right? Even as the market may be at a high, the economic data is still negative at a low point, and it should improve from here, because this is probably the worst case as part of the slowdown that occurred because of the election season, where government spending actually slowed down. So once that picks up, we go back to what is expected by the year end, close to 7% or more. And I am thinking that once the rate cuts happen, and if there is a pickup in demand, why can't you actually start pushing towards 8%? If not in this year, it will become very apparent for next year. So somewhere you'll go back to 7.5%, and then eventually to 8%. That is how I think. So I think we are at the bottom of the GDP growth cycle and only likely to pick up. And that eventually reflects in earnings growth and so on. And everything starts doing much better than it is doing. And that is why financials or interest rate sensitives should actually do well in an environment where rates are getting cut and the economy is at the low point and can pick up from here. So a lot of interesting things that can happen. A lot of triggers across sectors that the government is creating through policy. Pay attention to them, and stay invested. Look for investing opportunities on dips. Don't chase valuations, but look for places where there's growth and low value. There's a lot of places outside those couple of overvalued sectors, but even the overvalued sectors continue to boom because growth is still there. So if you have growth, valuations don't really correct that easily. They can continue to go higher and higher. But at some point of time, you will get that valuation price correction, and then that gives you a bigger opportunity. So that is where there can be a trade inside long-term investments also. I don't know whether that trade is there right now. We waited for a long time for that to happen. Some of the stocks are showing short-term weakness, but will it just be a routine correction back to the 40-50 day average, say for a Hindustan Aeronautics, or will it be more than that? Very hard to say. The only thing you can do is patiently wait, and everyone manages risk in a different way, right? Depending on his entry point. Should you really be trying to exit short-term highs and lows? The answer is no. I mean, if you're a long-term investor, you'll wait for some longer-term trend reversal or a loss of momentum on higher degree time frames, like my monthly RMI going into sell, and then the weekly chart showing weakness. That is a risk management point for me on a long-term investment. I wouldn't look at the short-term swing and try to get in, get out of a stock, or the RMI on the daily chart to take a sell on an investment theme, or try to manage an investment risk. I really have to go to higher time frames to think about that. And at the highest level, I would look at the quarterly wave count, because unless you complete 5 waves on the long term, the larger trend is not over. So now that's a lot of technical talk, things that you may or may not be conversant with. If you're not and you want to learn about it, you can. We have a complete YouTube series. And since I'm talking education, we are going to be in Jaipur for our annual event. What is our annual event? Essentially, everybody who's completed the mentorship program at IndiaCharts, or all the 3 levels over our video series, those are eligible to attend what is our annual 5-day 6 nights event, usually at a location. We've done Lonavala, Goa twice, and now this year it's Jaipur, where we spend time together, discuss markets, charts based on the trade setups that we really, I've really used over the years successfully, and which we teach from basics of technicals. We go to advanced Elliott wave position sizing, trade management, economic, macro cycles, all of that, wherever we need to emphasize and talk about more, make people more confident about being able to take opinions on where things are headed, how they are working, and how to manage their portfolios. All of that becomes part of our discussion for a greater learning experience. So that is what we do. So this year's event, of course, coming up there, where we discuss many of these things again as to how to manage around this environment, how to manage trades or portfolios. And that should be very interesting as we do it again. People do attend over the years, over and over again, and you're free to do that. The only thing we want you to do is complete those sessions or levels, so that you are at the same level or same knowledge level as others who are attending, and we are at par and having a discussion that makes sense for everybody. So that is the minimum requirement. Other requirements are that we do have a WhatsApp group with the entire community for those who complete the live sessions, along with those who've only done videos can actually give the test. That is, we have an online test, and if you do clear that clear the test, which is online on the IndiaCharts website under the mentorship, then we can know that okay, you have completed all the levels successfully, and can become part of the WhatsApp group, because you have not really attended live sessions, right? I just don't want somebody to click on the videos and say, hey, I completed the videos. You want to make sure you did it seriously. And there are, of course, assignments along with that, which you can post, get answers to that from our team, and improve your learning journey. So take advantage of all of that. So thank you for listening. I've sort of taken you around the markets and around what we are doing and what is coming up. The event is from the 10th of this month, 10th of September to the 15th of September this year. So that is what we are all going to be doing. And all of those of you who are attending, we will see you all there, and have a great time. Thank you.